Hello everyone, I hope you are all doing fantastic. It is the 15th of September 2025 and my name is Marcello Colax. I'm the Managing Director at Clever Markets and I'm walking you through the European charts today. Alright, before we get started, just a little reminder that everything you see here of course is not trading advice and it's just my personal opinion, so don't take anything for trading advice here. Okay, so now this is the sentiment poll that we were confronted with at the start of this week. So you can see that week on week the market hasn't really changed all that much. We still see that the bears are taking up around like 40 to 35%, so they've given up a little bit of their share, and the bulls are marginally more in charge, 33% last week, 41 or 42% this week. So although the percentages have changed, the balance has slightly shifted, it is more or less, I want to still call this like reasonably balanced. There's still a big chunk of market participants that are expecting the price to move rather sideways. And let's have a look at what is actually happening. Okay, so we are here on, there you go, on the overview chart. We have the TTF front month and the NBP front month, TTF and NBP front season. We have EUAs, we have German Power, we have Natgas, Henry Hub, and we have Brent. The front month products, they went lower quite significantly. They picked up with lower lows and lower highs, but more recently they all started to flatline. I say most recently, I think it's like more than a month ago already. Whereas the seasonal products on the TTF and NBP, they continue to move sideways for quite some time. So they are a little bit less convinced of any sort of like strong direction whatsoever. Now the EUA bulls had quite a good run last week, but our proprietary algos coupled with traditional technical analysis showed us that the market is more likely to peak out, and we have drawn on FIB retracements to assess how low the market is most likely to go, but more about that when we look into the markets specifically. Now German Power is still moving in this crazy wide range. I mean, it's been quite some time now. The market has peaked out and we are now once again at the 200-day exponential moving average support. The question is, where do we go from here? On Natgas, it is fairly predictable. We are still in the flow of lower lows and lower highs. The market has topped out and there's a chance for us to continue lower overall. Brent has been moving into an increasingly tighter range. This is not fun, especially not on the daily chart. Anything here is best traded on the hourly chart, as are most markets right now. Okay, let's go into the details, and we're not so fast. So the next Clever Markets Technical Analysis Academy is launching on the 6th of October 2025. Join me, there's only a few weeks left. I had to open a second cohort because the first one sold out before I could even advertise it. Now I'm extending this offer to everyone who hasn't had the chance to join the first cohort. So if you want to be able to distinguish between corrections and reversals, if you want to spot fake outs, if you want to know when the trend is more likely to reverse or if you're going to continue higher, if you find it increasingly difficult to trade this volatility, then join the Technical Analysis Academy. It is a skill worth having in your trading career. You only need to do it once and you need to do it right, and most importantly, you don't have to do this alone. Get in touch with me if you want to learn more. And now back to the market details, and we are starting with the TTF front month. I want to quickly show you the weekly chart where we are seeing that we are working within this tight band of 30.32 and 36.32. I mean, tight relatively speaking for the weekly chart. You can see we don't really expect any strong movements either way anytime soon. We see that the momentum has flatlined ages ago and we are not getting any sort of signal on the stochastic. So for now, I don't really expect anything big to happen here, like in terms of like big momentum trade, right? But let's have a look at the daily chart, because that is where the trading decisions are actually made. So you can see I am working with this descending channel here. Has been pretty accurate for the longest time, so we get this flow of lower lows and lower highs, right? So if you're a physical trader, then here you would, and your window is closing, then here you would always know that okay, so the market is probably likely to bounce, and I think that my corridor or my window of opportunity is closing up, so maybe I was looking for buying opportunities in these troughs. If you're a speculative trader, then these troughs would have been good long opportunities. So how speculative and physical traders are making use of the markets is something that's covered in the Clever Markets Technical Analysis Academy that's coming up in October. So right now we are working within this symmetrical triangle here, and we see that, we are moving into an increasingly tighter range. This means that we have to switch strategies. So instead of looking for big momentum trades that are usually confirmed with trend and momentum tools like the MACD for momentum and the moving averages for trend tools, or if you want to do Bollinger Bands or Ichimoku clouds, it's all the same, yeah? Not all the same, but they're all working for like trending markets. This doesn't really work here. So if we are in an increasingly tighter range, if we are in a sideways market, then we stop looking at trend tools and we stop looking at momentum tools. And instead, we are starting to look at oscillators, because oscillators help us with ranges. But here's the thing. If we really try to trade the ranges, even the daily chart is too high, because right now a trend a swing just consists of like 2 or 3 candles, right? And we are so deep, now one tiny swing consists of maybe just one green, one red candle. So if ever your trading strategy starts depending on hoping that the next candle is green or red, that's showing me that we are in a too high of a time frame, and instead we want to move into the hourly chart. So, we'll do exactly that right now. You can see on the hourly chart, it looks like we have a trend going on more, so it's a little bit nicer to trade. If we have this flow of higher highs and higher lows, that's much easier to trade than just 2 green candles on the daily chart, right? So once again, if we identify on the daily chart, we identify a range market. That means we are switching from a momentum to an oscillator strategy, so from a trending strategy to a mean reverting strategy, and then we are moving into this lower level time frame, so in this case the hourly chart. Okay, so now even here on the hourly chart, we see that right now we are working within this rectangle where the market is bouncing around 32 and a 33.4 range. Right now the market is within that range, and here once again we are in a sideways range, so we are not looking at trend tools, we are not looking at momentum tools, and rather we are looking at oscillators. So this oscillator gave us a bullish signal some time ago. Once again, oscillator very often misunderstood as a tool. So no, a bullish signal is not given by moving into the extreme territory, overbought or oversold. Rather, the bullish signal is given by moving out of it again, right? So because an oscillator shows us what is the market doing right now. If we are moving into oversold territory, that means the market is closing closer to the low of that day's candle. That means it's a downtrend. And if we are in overbought territory on the oscillator, that means that the closes are closer to the upper end of the range. So what is that? That's a bull trend. So moving into the extreme territory is meaningless. It just means we have a trend going on. If we move out of it, that is the signal, because it's showing us we are no longer making higher highs, we are no longer making lower lows, right? So this is then the reversal signal, very often misunderstood, and also other misconceptions about oscillators, all covered in the Clever Markets Technical Analysis Academy starting in October. Okay, so this switching between a trending strategy and a mean reverting strategy is the difference between a good and a bad P&L, because we need to switch strategies, also covered in the Academy. I'm going really heavy on the Academy right now, am I? Okay, so what is happening next? The market seems to have topped out. We have small candle bodies and long wicks, which usually is a sign of the market topping out, very standard signal. So right now, I would say that the market could potentially push lower. Now here's the thing, if you really want to get a good start into the week, put the bearish validation level at 32.48, which is this trough, and put the bullish validation level at 32.9, and then you simply know like which case is more likely to play out. But in either case, it kind of looks like we are ready to push past either rectangle range. Yes, I do acknowledge that the oscillator still has some room to grow before we move into overbought territory. So there is still some room. Why not? So scenario 2 isn't entirely unlikely, but please do make note of this range on the hourly chart. Okay, now this is all for the TTF front month. Now let's have a look at the EUAs. And here on the EUA market, once again, I think like the daily chart is a little bit more interesting, so I'm just going there directly. We have had this symmetrical triangle within this descending channel, so it's pretty cool. So once again, we are flowing lower. We have stopped making lower lows and lower highs, which is a sign of bearish exhaustion. It's like a first signal of bearish exhaustion. However, the bulls aren't fully in charge yet because we haven't pushed above this channel. So what do we get? A symmetrical triangle. Once again, the market is moving into an increasingly tighter range. That also means we have switched from a trend following methodology within the channel. We have moved towards a mean reverting strategy within the symmetrical triangle. Here we apply the exact same logic. Now we understand that momentum tools like the MACD kind of stopped working, because you can see we're not really making new highs, we're not really making new lows, it's like going nowhere. The trend tools, the 8 and 12 exponential moving averages, they have flatlined, so we don't want to use trend or momentum tools. What do we do instead? We look at oscillators. Aha! But we're not really getting any nice bullish signals or bearish signals whatsoever right now, because the range is way too small. Can you see, like one up leg, one down leg, one up leg is now consisting of like, I don't know, 1 or 2 candles. So what do we do instead? Right, we move into the lower level time frame. So this like switching between the time frames and knowing like when to move lower, when to move higher, when to introduce more detail or when to reduce noise, all covered in the academy. So here once again, exactly the same picture. From an ascending channel, we have now moved into a rectangle, exactly the same as on the TTF, and we do apply the same logic. We have tiny candle bodies with long wicks showing us that the market is testing for a direction. Nobody is really convinced, but hey, this was the end of the week and the end of the session, so a little bit of uncertainty was to be expected, so don't take it like too seriously, okay? Overall, there is no clear preference between the bulls and the bears. I think the market could go either way. The bearish case would be confirmed below 32.48 and the bullish case would be confirmed above 32.9, and then there is a chance for us to actually push past that range, which would then inform, of course, what's going to happen on the daily chart. If the alternative case, triangle upside resolution, or the alternate or the preferred case, downside continuation is more likely. So let's have a look. Then the next market we are looking at is the German power front year. So what's happening here? What's good on the German power market? We have been working with this head and shoulders pattern since forever. We've got a head here, we got the 2 shoulders here. We do have the neckline at 80, and this is where we are right now. So usually this head and shoulders pattern is eventually resolved to the downside. Not really happening right now yet, so we still have some room to grow before we even find the 80, but overall you can see our view is still rather bearish even on the weekly chart, because that's what usually tends to happen with head and shoulders patterns. But of course we don't trade the weekly chart, that's just for a big overview, and that's simply sideways with a slight preference towards bearishness. So trading decisions are made on the daily and on the hourly chart, so let's have a look at the daily chart first. Here we are within this descending channel, pretty neat. We have the peaks and the troughs, everything is nicely hit. We just hit the upper end, and what did we do? We put on the fib retracements. So we put, let me zoom in a little bit more. We put the 100 down here and the 0 up there, because we are trying to see how much the market is now retracing from this preceding uptrend, right? If this is the uptrend and we retrace 100% of that, that would mean we've undone everything. So 100 down here, 0 up there. Last week ended with, let's call this a hammer. So a hammer is usually a bullish reversal candle pattern, but it happened too far and too close to the top. And also we did get a bearish signal. Here you see this is a bearish signal moving out of overbought territory on the stochastic. And yeah, this is not really a preceding downtrend, so please don't confuse this for a hammer candle. How to identify candle patterns, when to know if they're more likely or less likely to work out, all of that is covered in the Clever Markets Technical Analysis Academy, starting on the 6th of October. It's 5 weeks, by the way. Okay, so for now, the market is still more likely to move down. Look at this. The MACD has potentially topped out. Yes, we are bullish. We are above zero. But for now, the market is hinging. The tool is hinging. So hinging simply means we are not immediately pushing higher. This is like hinging lower a little bit. So I'm not super convinced by a bullish continuation, but please do keep an eye this morning on the 32.6% FIB retracement at 86.07. If we find support here and we bounce, then the alternative case scenario 2 is more likely to play out, and the bulls would be confirmed above 87.94. Let's call this 88. The bears, however, they would be making a good case below 86.07. Then the bears would simply continue first towards 85. Now this like minute detail you can already see here. This move could happen within like 1 or 2 days. So what do we do instead? We start looking at the lower level chart, because here we are dealing once again with swings, and I find this super interesting. We did have this rectangle playing out over the last week, right? With support at 86.5 and resistance at 87.94. And this range was resolved to the downside. Now we did have a retest, and if this resistance area holds, this 86.5, if this area holds, and I think it's kind of likely to hold, then the bears would continue lower. And the immediate downside target, as calculated from the rectangle, is here at 85.19. Now you might be wondering, how did we get this target? Well, what we're doing with a lot of candle patterns, chart patterns, we simply measure this distance here and then apply it to the breakout direction. In practice, simply use, so you don't have to whip out your calculator, just use the Fibonacci extension or the Fibonacci projection level. You simply mark out the peak and the top, and then you simply mark out the break level right here. Then you see 85. Hold on, this is wrong. Okay, okay, so the support target, oh my god, is at 85. There you go. 85. There you go. Whew, that was close. So this downside, this rectangle downside target is at 85. If this holds here, then we could push towards 85. I think this is super interesting. Tends to work out on the European energy market. So I kind of like this. Also, we had this bearish setup here, a bearish engulfing candle pattern where this big red candle is engulfing the previous smaller bodied candle. Super cool. So let's see what happens this morning. The bears would be confirmed with a close below this candle pattern at 86.35. Then you could make it to 85. The bearish scenario would be undone above 86.7 because then the bulls would simply continue. I'm not predicting like a super bullish case. I simply think that we'll just reintegrate into this range market that we had previously. Okay, so this is it for today. I hope you found this useful. Everyone have a good start into the week. If you want me to cover any more markets, then do let me know. If you want to have a look at any sort of spreads or any front quarter products, anything further out, let me know. I'm your guy for that. Everyone have a good start into the week. See you around, and bye bye.